Over the last 100 years, stocks have outperformed real estate by roughly 5 times. Not even close. And yet homeowners end up with nearly 40 times more wealth than renters. Read that again. A worse asset, but way richer owners. The math shouldn't work, but it does. Every year, every data set. The reason is surprisingly simple. It's not the home. It's not the market. It's not timing. It's something your realtor and your stockbroker have a financial interest in hiding, because once you get it, you don't need either of them. I'm Kevin. Here's what actually makes you richer, why most people get it wrong, and the one factor that decides everything. Nothing to do with the asset itself. Let's go. Over 100 years, the S&P 500 returned about 10% a year on average. U.S. home prices, roughly 3.5% nominal. Under 1% real. Drop $120K into stocks for 30 years, you end up with roughly $2 million. Same money into home appreciation alone, about $380K. Stocks lap it. So sell the house and buy index funds? No, because real estate has a trick. Stocks don't. Leverage. Buy $120K of shares. You put up $120K, buy a $600K house. With $120K down, the bank gives you the rest. You control 5 times more asset. A 2.5% house price rise on a $450K home with $90K down gives you about $11K gain. Roughly 12% back on your cash. Add mortgage paydown, and you're near 15%. A 4% rise gives roughly 20% return, better than stocks most years. That's why people swear by houses.
I swear by you,
but
house?
Leverage cuts both ways. In the last big crash, stocks fell over 50%, recovered in about 6 years. U.S. home prices dropped around 25% nationally, but some markets fell 60%. Real recovery took over 12 years in many places. A $90K, down on a $450K house. A 15% drop wipes out most of your equity. You can't sell. You're trapped. Stocks? Lose 30%. You still have cash and can walk away tomorrow. So why use leverage? Because prices mostly rise. And when they do, you win big. But here's what people forget costs. Taxes, insurance, upkeep. On a $450K house, property tax, insurance, and maintenance can easily run $6K, $12K a year. Selling costs another 4 to 6%. The average homeowner overestimates their return by nearly 15 times. They remember the sale price, not the decades of bills. Stocks cost almost nothing. An index fund charges 0.03% a year. No leaking roofs, no broken AC, no midnight calls. So why do homeowners end up richer? Because you can't panic sell a house. It takes months. There are fees. That friction stops you from making dumb decisions. Stocks let you sell with one click, and most people do, at the worst time. The average investor underperforms the market by 3-5% a year because they panic and buy back high. Federal Reserve data shows the median homeowner has roughly 40 times more net worth than the median renter. Not because homes grew faster, but because the mortgage forced saving. What about rentals today? In most U.S. markets, the math is broken. The old 1% rule, monthly rent equals 1% of purchase price, is dead. On a $450K house, renting for $2,000, after taxes, insurance, vacancies, and property management, you're losing money. Mortgage rates are above rental yields almost everywhere. So who wins? If you have a steady job, a solid down payment, and you'd otherwise blow the cash, real estate works. If you're disciplined, live in an expensive city like NYC or San Francisco, or might move in a few years, stocks are better. For most normal people earning $70K, $100K a year, do both. Buy a modest home, ideally 1.5 times your annual income or less. Max your 401K match. Put the rest into a low-cost index fund. That's it. Boring, slow, effective. The richest version of you isn't the one who picked the perfect asset. It's the one who stuck with anything, for 30 years. Hit like if this helped. Subscribe for real numbers, not course-selling nonsense. I'm not a financial advisor. This is for education. Your results are your own.